All right. Matt the Mortgage Guy here. This video was just too good not to react to. And Graham Stephan being the GOAT of finance on YouTube, he talks about a lot of stuff. He's got a background in real estate. He's got a background in housing, so he understands it really well. Had a lot of good points in this video. Some of the stuff I think may have been a little bit exaggerated. So I just want to talk about some of the key points as they relate to mortgage and whatnot. Before I jump into it, if you like straightforward mortgage and real estate content from a mortgage broker who's in it all day, every day, consider subscribing to the channel. Like, share, do all the stuff that helps the YouTube algorithm, right? So before I jump into this video, if you don't know Graham Stephan, millions of subscribers, talks about real estate, the real estate industry, talks about finance. He's, one of the pioneers of YouTube finance. So most of you guys probably know who this guy is. This video he made just a few days ago was gold. There's a piece in it that's super gold. I want to make sure if you didn't see it, you get to see it. But I wanted to kind of react to some of the stuff in the video because I think it's important where, one of the points he made was this recent increase that they've talked about in loan limits. Is it a dangerous thing that we're letting people borrow more and more money? What you have to take into consideration is forever, those loan limits stayed still. They didn't go up. But as prices have increased and people continue to make more and more money, of course, the loan limits go up, and the county loan limit goes from 417 to 424 to 448. And, it's gone up consistently since like 2014 or 15 after it stayed flat at, I think, 417,000 for a long time. Now that limit next year is going to be somewhere around the $625,000 range. And in some counties, you're able to borrow up to 940,000 or even more once those loan limits are announced the end of November. So without further ado, let's get into a little bit of Mr. Graham Stephan's video here.
A deal. They said that they would bail out Fannie Mae and Freddie Mac under the condition that they would be placed in a conservatorship and
back
all
during the
profits
crash
would go back to the U.S. Treasury. Think of this kind of like a big boy timeout, where mom and dad got them out of trouble, but the punishment is that all the profits go back to the parents. But since then, both Fannie Mae and Freddie Mac have been under that deal with no plans of being privatized anytime soon. But the result is that the U.S. government still oversees both agencies and makes sure they don't take on more than they can reasonably.
This is true, and this is a good thing. And there was talk of them coming out of conservatorship. I think that talk all but went away. And so the fact that they're, under conservatorship with the U.S. government being overseen is a good thing. Mortgages are as safe and secure and really as conservative as they need to be so that we don't see any crazy repeat of a 2008 crisis. Next, he's going to go into a funny little skit, which I think is absolute gold.
Handle. Although, is this actually setting ourselves up for another 2008 great financial crisis? Well, before we go into that, I want to thank our lovely partner who's made this entire video possible, and that would be the government. Have you or anyone you know been diagnosed with housing unaffordability? Are you sick and tired of starter homes selling more than you could afford on a salary that hasn't increased in more than 5 decades? Well,
sure, he's being a little bit facetious with some of this stuff, a salary that hasn't increased in 5 decades, but I'm sure a lot of people relate to this, housing unaffordability. Newsflash for anybody who hasn't really done the math, when you take income versus a mortgage payment, since rates have come down so low, even though house prices have increased, we're at one of the most affordable times. And I'm not making this stuff up. Let me know if you want to see that 50-year graph that my buddy Mike Zuber did on home affordability, because in 2020, it was more affordable than almost any other time in history when you look at wages versus mortgage payment, right? Even when prices are up, when rates are down, that payment versus wages is at a better ratio than a lot of other times in history, like one of the best, right? So go on, Graham.
Thankfully, it's not your fault, and we're here to help. Instead of solving the root cause of the issue, including but not limited to zoning restrictions.
This is gold. I don't want to interrupt this too much, but it's true. Instead of solving the problem with low inventory and it being almost impossible to build new stuff without all these restrictions in place, like the government's got all kinds of other ways to fix it, right? Not getting at the root problem.
Constrained supply, asset inflation, excess capital, labor shortage, and low interest rates. It's easier to ignore everything and just give you a larger loan instead. How about this $3 million two-bedroom home in Venice Beach that sold for $700,000 a year ago? Call us. We'll give you a $2.9 million loan, no questions asked. Or what about this overpriced $1.5 million townhome in San Bernardino that's not worth the seller's asking price? Well, that's not your problem, as long as you promise to make the payments. We'll give you whatever you need, backed by the faith and service of the U.S. taxpayer. And best of all, if the payments are too high to afford on a stagnant wage, we'll give you a 40-year loan instead. That way your children can deal with it. Call toll-free 1-800-SUBSCRIBE and we'll send you a completely free, no-obligation DVD on how we plan to tax the people who make slightly more than you do. Because we live by the motto that if we don't know what we're doing, the best solution is to raise taxes. Again, just call 1-800-SUBSCRIBE, and with that said, we'll get back to our scheduled programming. All right, so in terms of how this relates to the 2008 Great Financial Crisis,
he actually goes in here, and we won't, listen to his video for the next 5 minutes, but talks about how different 2008 versus today is. 2008, you can get a loan with no income, no assets, no job, stated income. All that stuff that existed in 2008 no longer exists. You've got to have a down payment. There's no government-backed, Fannie Mae, Freddie Mac program where you can do 100% financing like you could in the past. You can do 3% down. You can do a 3.5% down FHA, but you've got to have a certain credit score. You've got to have income, and you've got to fit within the debt-to-income ratio guidelines. All the stuff that happened in 2008, variable rate loans, negative amortization loans, the loans where you didn't need to prove any income at all. None of that stuff exists. So it's so different than 2008. It's not even funny, right? Laws in place to make sure that appraisals are on the up and up, and appraisers aren't appraising something for $100,000 more than it's worth, fake pictures, the whole 9 yards, right? And so really, really interesting stuff he goes into, and it's all fact, right? It's, he's not doom and gloom necessarily. Some of it was kind of just poking fun, right? And in 2022, he talks about home prices going up. And what else did he talk about here? I guess just the housing market and the health of the housing market in general, which I think we all agree it's tough for some people, but there's no big housing crash on the horizon. And there's certainly not an issue with mortgages. There's no red flag because we're lending people more. It was more of a talking point, in my humble opinion. So anyhow, just wanted to share it. More than anything, that little segment he did, that little ad was just hilarious. And I wanted to be able to share that with people that might have missed it. So any mortgage questions at all, please feel free to reach out. GreatMortgageBroker.com. Go there, fill out a quick form. Let us know where you're at, what you're looking to do. We're more than happy to help. And until next time, we gonna see.